One of the first questions I always get when people hear about early retirement in their 40s or 50s is this: how do you actually pay the bills without getting hammered by taxes and penalties? Because let's be honest, the IRS does not make early retirement easy. That 59 and a half rule is like a wall. You touch your retirement accounts before then, they hit you with taxes and penalties. And I have yet to meet anyone who is thrilled about handing over extra cash to the IRS. So, how do early retirees actually pull it off without draining savings or paying penalties? Let me break down 5 real strategies that make early retirement possible, and you will see it's not as far fetched as it seems. So let's dive right in with the first strategy, using your Roth IRA contributions. But first, I want you to remember this. There are 3 different buckets in a Roth IRA: contributions, conversions, and earnings. This is a crucial distinction. Your contributions are the actual money you put into the account yourself with after tax dollars. The conversions are money you have moved from a pre-tax account, like a traditional 401k, into your Roth IRA. And finally, the earnings are the growth on all the money, the interest, the dividends, and the capital gains. But here's the thing: you can always withdraw your direct contributions from a Roth IRA at any time for any reason without paying any penalties or taxes. I'll say that again. Contributions are your get out of jail free card, and you can pull them out whenever you want. You could be 30, 40, or 50. It does not matter because you already pay taxes on your contributions. The government cannot tax you twice. Let's use an example to make this super clear. Imagine you have $1 million in your Roth IRA. Now, let's say out of that $1 million, $200,000 came from your direct contributions over the years. The other $800,000, well, that's your earnings. Now, if you retire at 50, you have access to that $200,000 in contributions. You can literally spread that out and live off of it. And that's $20,000 a year for 10 years, totally tax-free and penalty-free. And think about that for a second. If your annual expenses are, let's say, $50,000, that $20,000 covers a good chunk of it. And we'll get to how to cover the rest. So while your earnings are locked away until age 59 and a half, your contributions are liquid. They are right there ready to go. And you just have to be careful not to dip into your earnings or you will get hit with a penalty. And that's why it's crucial to keep track of your Roth IRA contributions every single year. And I'm going to talk about how to take out the Roth 401 contributions for early retirement in a separate video. So be sure to subscribe if you haven't done it already. Now, what about your pre-tax accounts, the big ones, your traditional 401k, your traditional 403b, or your traditional TSP? This is where the Roth IRA conversion ladder comes in, and this is a fantastic tool for anyone looking to retire early. The basic idea is that you move money from one of your pre-tax accounts into a Roth IRA. So now let's walk through a real world scenario. You are 45 years old and you have decided to hang up your working boots, and you've got $500,000 in your traditional 401k. But here's the key rule: you have to wait 5 years before you can withdraw that converted money penalty free. So if you convert it in 2025, you can withdraw it penalty free in 2030. It's like a time release capsule for your money. And let's use the same example from earlier, from age 45 to 55. And you can set up a strategy where each year you convert a chunk of your traditional 401k, traditional 403b, or traditional TSP into a Roth IRA. Say you convert $10,000 this year, you'll pay income taxes on that amount. And if you're in the 22% tax bracket, you'll owe the government $2,200. And I know no one likes paying taxes, but think of it as a small fee for long-term freedom. Now that $10,000 sits in your Roth IRA, the clock starts ticking. After 5 years, you can withdraw that conversion amount penalty free. So again, if you convert $10,000 in 2025, you'll pay the income taxes by the tax deadline in 2026, and then you can take that $10,000 out tax free and penalty free on January 1st, 2030. And the key is consistency. Each year you convert a chunk, pay the taxes up front, let the 5-year timer run, and then pull it out when you need it. By repeating this process year after year until age 55, you build a steady pipeline of money that becomes available once you hit your early retirement years. So from age 45 to 55, you make that $10,000 Roth IRA conversion from your traditional 401k. You're going to pay the income taxes every year from age 45 to 55. And then from age 50 to 59, you can take that $10,000 tax-free and penalty-free. But from age 55 to 59, you do not need to make any more conversions, because once you reach age 59 and a half, the training wheels come off. You now have full access to your Roth IRA, contributions, conversions, earnings, all of it completely tax-free. That's the amount when the early retirement strategy turns into full retirement freedom. If you're still confused about this, you should consider joining my private client program, but you have to first book your 60-minute consultation with me by visiting 568.com/consultation. Now, for a more direct approach that doesn't involve any age-based rules, your taxable brokerage account is the answer. And this is the money that you have saved and invested outside of your retirement accounts. And this is the Wild West, so to speak. But there are some big tax advantages you can tap into, specifically the long-term capital gains tax rates. The tax code is set up so that you can actually pay 0% in capital gains taxes. Yes, you heard me right, 0%. The way it works is that for a single person, you can realize up to a certain amount in capital gains and pay nothing on it. In 2025, that number is $48,350. But here's the kicker. You get to add your standard deduction on top of that. For a single person, that's another $15,750. So as a single filer, you can have a taxable income of up to $64,100 and owe no federal income tax if your only source of income is your long-term capital gains. For a married couple filing taxes jointly, that number is even more powerful at $96,700 plus the $31,500 in standard deduction for a grand total of $128,200, all completely tax-free. Now, let's use an example with an ETF like VOO. VOO tracks the S&P 500, and it was my very first ETF I invested in when I started my FIRE journey. So let's say you've got $1 million invested in VOO, and when you're retired, that fund will be doing two things for you, providing dividend income and generating capital gains. Here's how that works. The dividend income is what the companies in the S&P 500 pay out to shareholders. That's a small, steady stream of cash. And the capital gains are the appreciation of the shares themselves. You sell a portion of your shares each year to cover your expenses. And as long as you stay under that magical tax threshold, you pay nothing to the IRS. And this is why I always tell people to aim to save at least 10 to 15 times their annual expenses in a taxable brokerage account. If you need $50,000 a year to live on, having $500,000 in a taxable brokerage account gives you a massive buffer and allows you to use this 0% tax rate to its full advantage. So that $1 million in VOO with 1% annual dividend yield would pay me $10,000 a year. And that's going to be taxed at 0% under qualified dividends. And if I withdraw an additional 3% from VOO, that's another $30,000 a year. And that's going to be taxed at 0% under long-term capital gains tax rates. And keep in mind that not all $30,000 will be from capital gains or realized capital gains, because some of it might be from my contributions. And the IRS cannot tax my contributions because I already pay taxes on them. So having a taxable brokerage account is going to be a crucial income source to fund your early retirement. Now, this one is huge, and it's specifically for those of you who get laid off, fired, or quit your job at a certain age, and it's called a Rule of 55. The IRS has a rule that allows you to withdraw money from your employer's traditional 401k, traditional 403b, or traditional TSP without a 10% penalty if you leave your job in the year you turn 55 or later. So if you turn 55 in September, you can retire in January and still enjoy the Rule of 55 because you're going to be 55 in the same calendar year. And the key here is that the money must stay in your old employer's plan. You cannot roll it over to an IRA or a new 401k and use this rule. So your IRA does not come with a Rule of 55, but your traditional 401k does. So if you're 55 and your company goes through layoffs and you can access that money, or maybe you are just ready to retire and you've been working at your job for a long time, you can quit at 55 and start taking distributions from that account immediately. And it's a fantastic little known fact that can be a real lifeline for early retirees. And keep in mind that you'll still have to pay ordinary income tax on these withdrawals, but at least you avoid that nasty 10% penalty. It is a powerful tool to bridge that gap between retirement and age 59 and a half. We also have the Health Savings Account, or HSA, and I've got to be honest, this is one of my favorites because it's the most versatile account in the entire financial toolbox. And the magic comes from the facts that an HSA is a triple tax advantage account. You put money in a pre-tax account, it grows tax-free, and you can take it out tax-free for qualified medical expenses. But here's what makes it a secret weapon for early retirement. There's no expiration on the medical reimbursement. Let me explain. You can pay for a medical expense out of your regular bank account today, save the receipt, and then years, even decades after that, you can withdraw that exact amount from your HSA. You could be 55, find a medical receipt from when you were 40 and withdraw that money tax-free. So here's a strategy you can think about for your early retirement. You live off your other accounts, your Roth IRA contributions, your taxable account, and maybe your rule of 55 withdrawals while paying for all of your medical expenses out of pocket. You simply save all of your receipts. When you get older or when you need a lump sum of money, you can start withdrawing from your HSA tax-free with no age limit to reimburse yourself for those past medical expenses. Put it all together, and it's a powerful way to build up a significant tax-free stash for later in life, all while knowing you have this medical reimbursement fund ready and waiting for you. But remember, there's no one size fits all here. The right mix depends on your situation, your tax bracket, your savings, your lifestyle goals, and frankly, your tolerance for paperwork. But the point is, the options are there. Early retirement does not have to mean draining your accounts with penalties or getting stuck without income. And if you plan carefully, you can piece these together and create a smooth income bridge to carry you through those early years. And peace of mind in retirement does not come from guessing. It comes from knowing the rules and using them to your advantage. And that's what keeps you from making those accidental, expensive mistakes that people regret later. So take this information, look at your own financial situation, and start planning. You can always schedule a 60-minute consultation with me by visiting firesignature.com/consultation. So what's stopping you from taking the first step today? And this has been another beast of a video, and I hope you got a lot out of it.